Stop right now and focus on this screen. Imagine billions evaporating overnight. That's the silver story unfolding. From $122 peaks in late January 2026 to crashing lows in the $70s, a 41% wipeout in days. One of the sharpest falls in recent history. But here's the puzzle that changes everything. A drop like this should mean oversupply flooding everywhere. Instead, physical silver is scarcer than ever, dealers limiting, mints halting. This isn't random turmoil. It's a crafted deception to push out the uncertain before the rebound surges. The paper market yells, "Sell now." The physical side signals this is the moment to hold. Why is the world's leading nation calling an urgent summit on critical minerals right after this destruction? What insights do they hold that the public lacks? And here's the fact that truly stunned me. While Western markets were in freefall, while experts called precious metals over, buyers across the ocean were calmly paying a 25 to 30% premium for the same physical asset. They weren't fleeing. They were stocking up strategically, without hesitation, as the West panicked. By the end of this video, you'll see precisely who was acquiring when others sold off. And 3 key indicators the mainstream overlooked. These 3 elements paint a vastly different picture from the narrative you've heard. Welcome to the channel uncovering the moves behind the scenes that big media misses. If this type of breakdown resonates, subscribe now because what's coming isn't on standard networks. And if it clicks for you, like it to help spread the word. Let's jump in. First, a quick setup. Silver surged from about $30 early 2025 to $122 by January 2026, over 300% in little more than a year. Gold smashed records above $5,500, fueled by reserve building, currency shifts, and booming tech needs. But the final stretch turned frantic. Everyday traders, hedge funds, and bots rushed in. Silver leaped 50% plus in January alone. Nightly Eastern pushes left Western openings gapped up. Then, the turnaround struck swiftly. A tougher Fed pick emerged. The dollar firmed up. That sparked the fire. Selling kicked off in Asia. The rally drivers switched to exits. The drop snowballed, calls for more collateral forced sales. Sales sparked more calls. Bots traded against bots. People couldn't match the pace. When key Western hours hit, the ruin was already deep. Silver shed 37% in one day, the harshest since the 1980s, described as utter devastation. But the first day wasn't the end. Weekend collateral demands hiked. For leveraged holders, it meant double up fast or forfeit all. Positions liquidated en masse. Prices sank deeper. The cycle intensified. Silver hit $70 lows, total 41% off peaks. Gold lost 20% plus. All assets-linked stocks, digital coins, resources all suffered. Most reports halt here. They detail the fall. Note the demands, advise caution, and shift on. Not us. 3 revelations flipped the script. The first hit hard when I dug into the figures. As the West sold in fear, Eastern physical markets did the reverse. Shanghai's spot for real silver ran at 25 to 30% above the Western crash level. Identical element to wildly different valuations. The area expected to panic paid far more. That's not casual action. That's deliberate, long view gathering. The second overlooked point. On Shanghai's futures contracts, struck daily, bottoms halted. Convert those bottoms to dollars. Their worst-case base stayed $12 Australian dollars over Western free trade levels. Their low was our high, and they didn't stand idle. They stepped in firmly, halting funds, cutting limits, restricting traders for weeks, aiming to curb overheating on rises, not falls. Yet despite that, silver stabilized and rebounded strongly from bottoms. Not how fading commodities behave. The third connects it all. A top Western bank, a powerhouse in metals 4 years lately, moved key precious metals functions to Asia, not growing in core hubs like New York or Europe. They relocated teams, tech, and strategy to where real demand surges, reserves build, premiums peak. Banks don't do that casually. They do it when analysis points to a lasting shift in market center. Now weave these 3. Eastern real buyers offering big premiums amid Western chaos. Eastern futures bases above Western trades, even at halts. A leading Western bank realigning to Asia. Add one more layer. This week, the United States hosts an urgent high-level gathering on critical mineral supply. Teams from various nations attending. Goal: bolster and vary sources of essentials for security and tech. Government speak for we have exposure, time to act. Silver is central here, more than most. It's not primarily trinkets or holdings. Silver gets used up in vast amounts by today's tech world. Solar tech needs it per unit. Electric transport uses it in power systems. 5G setups require it. Chips, advanced weapons, health tools, devices, all demand silver. Last year, industry alone took 650 million ounces, over half global use. The planet runs a steady supply gap yearly. Reserves deplete. Fresh, dedicated silver mines need 8 to 12 years to start. Much silver comes secondary from copper, zinc ops. Prices don't swiftly boost yield. That built-in mismatch drives government focus. From Wednesday's talks could come reserve building initiatives, fresh supply packs, boosts for home mining, controls on overseas buys. No minor steps. Nations take these when a resource is vital enough to bypass markets. China led with like actions on other keys. Now the US seems catching on. The events unfolded like this. Silver and gold peaked late January. Peak excitement, sudden flip, stricter Fed signals, firmer dollar. Asian sell-off starts, spirals on collateral demands. Record day loss, weekend demands, rise more, forced exits. Silver $270, sharp rebound to 18% up in days. Eastern real buyers premium throughout, their futures low above West. Major bank shifts to Asia, US calls critical minerals urgent meat, not coincidence. Now a trusted perspective to frame it. Ray Dalio, a top macro mind, notes true asset bears often need ongoing liquidity pull, not single hits. Rate rises, policy tightening, cash outflow months that ends bulls long haul. The Fed isn't there fully yet, even with hawkish pick, cuts still expected. The liquidity pull, Dalio means, hasn't hit hard, so the fierce drop may clear leverage and excess more than break the base case. The 1970s, mirror clearest. Gold from $40 to $200 plus, widespread hype, then 50% plus fall. Reports buried the bull. Many everyday holders sold bottoms in dread. Gold then to $850, huge gain for holdouts. The drop didn't kill the run. It cleared the casuals. Same may play here. Silver from $30 to $122, 41% to $70s, strong bounce to mid-$80s, gold 20% plus down, then up, not dying pattern. True buyers entered lows. Industry can't pause solar, transport, electronics need silver price notwithstanding. Some big users lock mine deals direct, skipping exchanges. That signals deep future supply worry. Here's what I tracked this week. The formal output from Wednesday's Critical Minerals gathering. Any talk of reserves, new ties, or silver as key. Any follow-in orders. The Eastern Premium, if high still, shows real, not tracking paper, and price moves if silver stays over recent bottoms, and climbs with premium up, confirms paper physical split, real and likely lasting. Before my view, for questions. If normal fix, why Eastern real buyers 25 to 30% over West? If demand gone, why China halt funds to curb buys not sales? If metals irrelevant, why top Western bank move metals ops Asia ward? If unimportant, why US urgent government meet on critical minerals post-crash? Mainstream skips these my personal read. No advice, just data view. I see the point paper and physical silver markets fully parted. They once synced roughly. Now two distinct valuations, Western paper leverage, futures calls, down 41%. Physical, tech, security, need steady. Eastern pay over $100 a quiv, while West at $72, not short-term gap, structural change, wealth shifted in crash, from fear sellers to data actors, from screen reactors to supply planners. Crashes do that. Weak exit, strong add. I think paper stays wild, disconnected long. But physical economy security core says different tale. My take? Could miss markets teach hard, but when premiums stay wide, governments meet urgent, banks shift Asia, hard to dismiss. Comment your view. Is this end or bigger setup? I check all comments. Sharpest ideas from you. If this lit something new, share with one who needs. Not subscribed? Fix now, we follow as unfolds. This is the hidden economy. See you next.